Check. Alright, looks like my volume was down on that. My bad, guys. Alright, I'll do the numbers real quick. On ES, I was saying that we do have levels at 4081, and that's supply on ES, and we have demand down here at 4048. So watch out for a possible bounce down there. The 200 moving average is also there. If they cross below that, that's a death cross. So ideally, that would be a good move. So that's one play there. On the 5 minute, they do have supply at 4064, and 4050 is where they're building some sort of demand. They tried to go up, but we're in a bearish trend, so the routine. When the red cloud is below the 50, we're taking short positions at the money zone or into this push phase, flush phase. But when you have demand, you got to kind of watch out because you will get this stall. All right, so that's one play there. Let's go check out SPY real quick, see what SPY is trying to do. All right, SPY kind of will have the same story, just different supply demand levels. On the 15-minute, we have supply at 407. Demand is established after yesterday's low at 404. So we're going to be looking out for those two levels there. Possible bounce zone down there. On the 5-minute, we have supply at 405. 42. Demand at 404.34. So about $1 there. Want to check that out. Supply at 407 and demand is at 404 on the 15-minute. Hey, good morning, brother. Supply is at 405s and demand is at 404, spot 37. VWAP on SPY is at 404.91.
Order filled.
Alright, just finished exiting the market on a play to that downside on futures. Don't want to go into the open like this. Chaz, what you thinking about, bro?
Man, I actually just got onto the screen like right now. I woke up a little later. But from what I can see right now, I mean, we have a 15-minute supply or demand down here at 404.30 and then one down there at 404.09. We got the 200 MA right here keeping us above. We could see a bounce off of the 200 MA. And then see a reversal or at least a push up to 404.97 before we get any other type of rejection again.
Yeah.
But that's all I'm seeing right now. But then again, we are in a downtrend right now. On the 15-minute, 5-minute, 1 hour. 1 hour just broke that divergence line, as well as the bottom BB band. We have a TP dot pulling up.
Yeah.
I low-key don't want to trade until JP speaks. I don't know how you feel.
That's at 10, right?
Yeah, 10 o'clock.
Got a little head and shoulder thing going on here on the 1 hour here. Here's your shoulder,
Mm.
left shoulder. Here's your head. Here's your right shoulder. And then he started coming down. If they break these lows, 403, we could see a friggin' further move to the downside. But we have strong demand here on the 1 hour at 404. 4
Mm-hmm.
and the 15. And he tried to build a 404 demand on the 5. It just got clipped. All right.
And then this is also supply turn demand, supply turn demand on the 4 hour.
Let's go check that out.
Yeah, we got the 50 HMA like right on us right now on the 4 hour. 200 MA right below us as well. Same scenario as like the 15-minute. I mean, we already cracked it on the 15. But
Ay, ay, ay. So, this was supply, turn demand. Let's see if, and it's in, yeah, this should be strong demand down here, guys. It shouldn't confluence with everything. Fucking 200 moving average. It was something we broke out of. Hopefully it's not a supply zone that they're going to take us back down to. This bearish trend, the macro bearish trend, but man, we shall see. Crack below that could be bad.
the 40409.
Yeah, just 404 level in itself on all time frames. That's the key level.
Yeah, every single time frame. Yeah. And then below that, I believe it's 40120, 40125.
What are you seeing there?
40120. Hold on, I'll tell you right now.
There goes the bounce from that level. Holy shit. Well, if you want to get in on shorts, the best bet is to get in at like around this cloud here. So 40460s. That's their 5-minute entry. Then you have a 40470 entry on the 15-minute. But again, this is your line to take out, and that's strong demand. So I don't know. I'm a little bit hesitant to take the downside move, but don't be. Just go with the trend.
Goddamn yellow candles, bro. That shit crazy. 5-minute, we got a whole fuckload of them down here.
On the 5-minute?
Yeah.
Oh, I got my 5-day up. Hold on.
I'm on a 1-day, I think.
Yeah.
Looking at some of these contracts, but none of them got any divergence lines or anything, at least for the price point that I can afford for the calls.
Yeah, so the 1 day is all the way down at standard deviation negative, well, pretty much +1. So demand is definitely down there. You see that 404 bounce, yo?
Yeah, you see that div line?
Yeah.
Fucking 5-minute div line. That shit paid. Bro, what does the orange buy mean if we don't have a channel cross yet?
What do you mean if it's only orange if there is a channel cross?
Really? Am I looking at this incorrectly? The 5-minute has the orange. Oh, never mind. It went away. I don't know. The 5-minute keeps flashing an orange B.
Yeah, it's probably triggering the price action is probably triggering it. Yeah, it looks like calls are really about to bounce the fuck off this level, bro. Yeah, I'm gonna sit on my hands for a minute.
Yeah, these calls are up about 60 cents a contract.
Are you a little worried about the depth limit not getting
All right, so guys, ideally I would say short that level right here on which is a 5-minute money zone, but yeah, I got too much like confluence going on at 404. We got like strong demand at 404 on 4-hour, 1-hour, 15-minute, and looks like 5-minute is trying to establish that buy zone. Again, you could just go with the strategy to just short a bearish trend on both time frames, 15 and 5, at any of these levels. We just wicked off of that 5-minute money zone. We may go up to 404.70s before they start going down. That's what we're supposed to do. But I mean, from 404.55 to 404 is just 50 cents. You know, it's if they don't break that strong demand, we'll just be taking 50 cents on a possible move. I don't know if that's smart. So then Jay Powell speaks in what, 20 minutes?
Yeah.
This fucking guy's gonna send the market. Woohoo!
One way or the other, bro. Ooh, white candle.
That shit might be go time. So these things came back to 143. We're about 10 minutes into market open, and yeah, there's no need to rush anything. Just chilling. But we have a decent range on the 15 too. 404 to, I think the 407 is supply. Yeah, 407 was supply yesterday. Bully, bully, boop, boop. Selling pressure on this 15 minute is at 1.3 million sellers to 700,000 buyers. With 3 minutes left to go. Contracts on the sell side got a white candle. Let's see how that goes. Hey, yo. Holy
Oh
shit.
damn, the puts are coming in, bro. Holy crap.
Buy longs down there. Looks like the flush is still going on right now. Well, they just activated it a couple minutes ago. Yeah. Ooh-wee. 2 million. That's enough strength to break it.
Yeah, that's
Keeps-
a lot of strength.
Keeps climbing. I mean, I'm not gonna do the breakout, so I wouldn't recommend touching this now. But that money zone entry on the 5 minute would have been nice. But again,
Right.
well, I mean, it's not a lot of sense though. Like, strong demand down there. If you would have caught that, you probably would have made 20 cents on these SPY contracts. It's not bad.
The 200 MA on the contracts, but then right below them, they have a divergence line that they created into demand. 50 HMA right below them on the contracts. Yellow candles on the contracts. Oh shit! You peeped that oversold band on a 5.
Yeah.
Order filled.
You took some longs.
Yeah, I'm trying it out on Tradeovate futures. Get another bounce from down there. It looks like they're gonna break though.
Yeah, they just hit 40409.
Let's see what the ad is doing here today. Ooh wee.
Your 15-minute candle currently bouncing off of the fucking divergence line.
Order rejected.
Gotcha.
What happened?
Nothing. I'm just playing with the settings. Ooh, look at that nice entry, boy. Sell market.
Yeah, back
Order
at the
filled.
again.
I just sold one. This one's break even, if anything. Fuck it. Stop. Wow. Smack the shit out of that one, bro. Yo, the ad is going up. If they break this low, then they probably make a move to the downside. It wouldn't even matter. I'm up crazy now.
How much are you up?
I just banked like 300 on that one. If it keeps,
Hey.
I gotta run it though. They about to smack my shit.
Stop filled.
Bastards. Stop me out. It's cool though. Oh shit. I don't have to deal with the IV on that one.
Bro, that's so smooth.
Shit is insane, bro.
Yeah, dealing with IV when that shit goes against you, bro, that shit's terrible.
Yeah, so they keep bouncing from that zone. I don't know if they're gonna keep doing it, but you guys can see how strong that zone is. However, they are rejecting the money zones on the other side, so still good to like take the shorts. Just position yourself well, because when this shit rips, it's gonna go nuts. Wow. Wow, that's some strength right there.
Yeah, contracts are busting right now.
Micro pullback. Yeah, the ad is still building. When he speaks, if that shit shut down, whee.
Oh, bro, how perfect would he be when he speaks? We reject the fucking 50 HMA on a 15-minute, bro.
Insane.
Damn, these contracts just bounced $1, bro. Crazy.
I'm about to go for a fucking lotto out here. Yeah, let's put that up to right. Yeah. All right, let's see. Is that the 15 money it just rejected? Yeah, 15 money's on it just rejected, 470-ish level. White candle close on a 5. Oh shit. Well. Oh my god, this shit looking strong on ES.
I mean, they got the volume right now, at least. I mean, it's not a million, but they got a high amount of volume in there right now.
Fucked up thing is this dude speaks in like 10 minutes, bro. Shit gonna shake all these contracts.
Yeah. The first like 2 minutes, that shit's gonna like fucking wick around. Watch, you already know.
I'm trying my best not to take a trade before this fucking guy speaks.
Oh, I know, bro. Oh my god.
It's easy long.
Told myself I wasn't gonna do that.
You're in?
No. No, I'm not in.
That pullback just now on a white candle, with yellow behind us, it's an easy long, bro.
Easy long, yeah.
That's just a 5-minute show, and we got the
TP dot, we got fucking on the 15-minute, we got a div line that we bounced off of literally symmetrically, bro, like 40409, like to the T.
Yeah. It's fucking-
I'm just hoping that when he speaks, that shit dumps again. We can get another entry down there.
It's over, Johnny.
Huh?
I said it's over, Johnny.
Yeah.
I feel like if it's going up before he speaks, bro, send this shit to hell. But
Yeah.
I'm just
I don't
watching for
know.
the 404 break.
So you know how it is. Usually when he speaks, we get a crazy rally. I don't know. For some reason today, I'm feeling like we might get a dump because he has to confess to Senate. So I don't really know like how the speech conversation topics are gonna go, and I don't know how people are gonna handle that. But we gonna see.
Yeah. It's not gonna matter. I think you just need to take a contract that you're willing to lose on and see if he shakes this shit. So far, the sellers are holding it down at the money zone.
7 motherfucking minutes. And we've only moved 6 cents. Crazy.
What did price?
Like from yesterday's close.
Oh,
We're basically trading at yesterday's close right now. It was 404 set 47.
oh. Yeah, and there was a mean dump yesterday. So bro, I'm also concerned about the head and shoulder breaking the lows too, bro.
Yeah, you talking about the head and shoulder on the 1 hour, right?
Yeah, that shit is on every time frame.
Yeah, every time frame. My biggest thing is, my boy, that motherfucking 399 looking juicy as a bitch. All the way down to the 200 MA. We're already in a downtrend on the fucking 1 hour. I don't know. That looks so juicy, bro.
Yeah, this is all speculation, but
All speculation, and then I don't want to take that because what if that bitch bounces off the fucking bottom BB? I'm gonna get killed.
this bitch finna pop. The puts have a fucking line right here, so that's probably a no-go.
On the top side of the contracts?
Yeah. And I think we're bouncing off of fucking demand on the calls, or maybe it's the opposite, who knows?
Stocks are flat as investors brace for Powell's remarks. That shit is not live, bro. I'm just trying to find the live video.
These fucking contracts ain't coming back cheap enough, bro. Somebody knows something on the call side. This dump ain't doing shit to these cons. Puts going up a little bit. That should dump it. Yeah. Bring your ass to me.
Oh, that shit is dumping. Pretty textbook. I mean, fucking money zone.
Get that.
Fuck, bro. I can't find the video. Oh, I found it.
These shits are holding value, bro.
Everything is. The puts are, the calls are, every single thing.
All the bid side just faded though. There's no buyers.
Yeah, there is no
Oh,
buyers.
people are still buying the puts though. I still see some orders on puts. At least on SPY.
These motherfuckers are crackheads, bro. Like 2 minutes before JP speak.
I'm telling you, some people know something, bro.
Oh yeah, that too. And then some people want to get their positions in before the speech. They think it might be an optimal fill.
There goes some calls. Somebody hitting some calls. $200 just stepped in there.
All right, let's watch this bitch, bro.
Wait, sweet Jesus.
Nice ass bounce.
You got him on over there?
He's about to. It's about to start.
What you got?
I'm waiting for the program to work.
Is it a video?
It's on Washington Examiner, but it says it's waiting for the website to like
Yeah, I got
catch
it.
up.
I got it.
You see that though? How it says waiting for CoinDesk?
Mm-hmm.
Yeah.
Here we go.
Oh. Dumpy. Big dumpy.
Holy
Oh
shit.
my fucking god, Spark.
Holy shit.
Puts might be it, bro, to be honest.
Let's see.
Oh my fucking goodness.
Keybot fell. Damn. Puts a shot up from 160 to 2 change. I just jumped in on some fucking calls. See if we get a bounce.
Yeah?
Yeah, it was 60 cents, so they're gonna have to take that. If we get this fucking bounce, is insane. Oh, that shit ain't coming. Kill it.
Oh my god, no way. What the fuck? I didn't get filled?
What is this guy talking? I didn't even hear him. Whoa, they cracked that 404 so bad. Yo, good shit, Nico. Stay with the puts. Damn, look at that fucking move.
Order filled.
You took longs?
No, shorts on ES.
Cool.
Order filled.
I'm out on those. My God. Nice. Fucking get out of that. They keeping the pressure on this bitch.
Yeah, bro, 2.2 million fucking seller.
Ooh, Jesus. Oh my god. Oh my god.
I'm going to do my best to enforce 5 minutes today.
Hearing entitled. I don't hear nothing from
This
this.
hearing will come to order. Welcome, Chair Powell. Thank you for doing your duty and seeming to enjoy it when you come to our committee. Thank you. Seeming to enjoy it. Today, we examine the Fed's actions to combat inflation and whether these actions are actually working, including how those actions affect American jobs and their paychecks. Prices are still too high across many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up? It's not the economic pundits and politicians who lecture us about discipline and stability. It's not the corporate executives who pretend they're making tough choices about prices while reporting record profit increases quarter after quarter and doing more and more stock buybacks. It's the people working hourly jobs to make ends meet. It's seniors on fixed income and Social Security. It's everyone who gets their income from a paycheck each month, not an investment portfolio. It's those same Americans who stand to lose the most if the Fed's actions to curb inflation go too far. No matter what goes wrong in our economy, a global pandemic, a war in Eastern Europe, weather disasters, profits somehow always manage to go up. Workers are left paying the price. As you've noted, Chair Powell, the Fed's tools are only one element in our fight against inflation. It's a complex problem. Interest rates are a single, we know, blunt tool. Raising interest rates can't rebuild our supply chains and fix demand imbalances from the pandemic. Raising interest rates won't end Russia's brutal invasion of Ukraine. Raising interest rates won't prevent avian flu from devastating 1/3 of our egg supply or weather disasters from destroying key crops. And raising interest rates certainly won't stop big corporations from exploiting all of these crises to jack up prices far beyond the increase in their costs. Last year, corporate profits hit a record high. Corporate PR chiefs assure us that these companies just have to raise prices. Their costs are going up. The workers just want to be paid too much. They have no other choice, they tell us. Yet when you look at their profits and their executive salaries and their stock buyback plans, it sure doesn't look like corporations have exhausted every available alternative. It's so brazen, even global bankers called on the Fed to identify this profiteering is one of the biggest drivers of inflation. Paul Donovan, chief economist of Global Wealth Management at UBS, wrote, "The Fed should make clear that raising profit margins are spurring inflation. Companies have passed higher costs on to consumers, but they've also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures." Think about that. From a chief economist.
Yeah, I took shorts during the pullback, and I'm out already though.
Yeah, I'm out too. I took them too. I banked 420. I didn't want to be greedy, bro, because you know how that should be. That shit done before that motherfucker even hit the podium, bro. That shit was crazy.
Yeah.
Quote, the Fed, understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up helping Wall Street, the largest corporations in the country, the wealthiest people in the country. Because let's be clear what we're talking about when people use the economic speak that can cloud this conversation. Cooling the economy means laying off workers. Lowering demand means workers get fewer raises. Of course, there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends that isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poor, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy. Look at East Palestine, Ohio, a community that Senator Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed hazardous material into this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of American ceramics manufacturing, at one time producing 80% of ceramics of dishware in this country. One county produced 80% of it. When I was there last week, I was talking to the sheriff at the 1820 Candle Company. He was talking about how the last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one third of its workforce in the last 10 years. Then you're surprised with these derailments?
Order
It's
filled.
the same reason corporations now keep prices high, even as supply chains stabilize. It's the Wall Street business model. Chair Powell knows that. I know that. My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy. Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that have seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity
Order
for that
filled.
dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect
Order
your
filled.
job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is
God, this
Wall
shit is
Street's,
melting.
no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling,
God, guys.
it will not only devastate CFPB, it will threaten the independent funding of many other federal agencies, including the Federal Reserve. I look forward to today's hearing, how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone.
No, I'm just kidding.
Senator Scott.
Mark, you hear me?
You said watch the reversal?
Okay, I watched
Morning, Chair Bell.
Bro, this
Sitting
shit
here-
is melting, bro.
Looking at my prepared remarks, thinking about,
Yeah, so
A, there's
if
an
you were
opening
to
coming
enter these
for Vice
contracts
Chairman
at
Brainer's
low,
moving on.
which
I
was
think it's-
basically at that high right before we done, bro. These bitches were $1.20, bro. They're fucking $5.90 right now.
That shit was crazy. Oh my God. Don't start your shit.
Printer
now.
man, pal.
Oh my God. The economy is actually doing well. I don't know what these man, sorry, fucking. Yo, but day, this shit is crazy. That shit went nuts just now.
Yeah, I'm just glad I banked 420 on that. I could
By
have made way more. But
400. That's crazy.
yeah, I banked 420. I just didn't want. I didn't want to be greedy, bro. I could have made more,
that
but I
shit
just didn't
was
want to be
nice.
greedy. Especially because my entry, you know how that shit be, right? With fucking Powell speaking.
Oh, they just cut the shit out of puts right there.
Yup.
Jump in on that shit. Here's the time.
Yeah, they're back to my exit.
Spending and printing trillions of dollars,
Trillions.
caving to the radical left in this country, seeing policies
Bro, that's
posited
Like, dude, what the fuck?
that led to the worst inflation in 40 years, seeing our inflation at 9.1%, seeing American families struggle because of the weight of the government on their
What are you
shoulders,
watching?
seeing
Same
the
thing.
devastation from South Carolina to Ohio. Is unbelievable
Mine was lagging.
that the
bro.
progressives in this country who caused a 9.1% inflation
Woo.
would then turn somewhere besides in the mirror
Shit's
to
still
see the
going, man.
absolute devastation caused by their out of control spending is remarkable. Remarkable. To stop the out of control inflation caused by the out of control spending, the Fed steps in
Bro, we going to 396, bro.
to cool the economy.
These
Well, the
motherfuckers
definition
are
of
mad.
cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices
What y'all doing?
devastates
Ooh, this shit's so dark.
single mothers around this country. For seniors on fixed income whose savings are being depleted with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go
Oh,
up
this shit
over
gone.
20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle.
Oh shit.
I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it
Oh shit.
that today it costs $433 more than it did a year ago? The answer is it is a crisis. When the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain that we haven't seen in my lifetime, run by my friends in the progressives. Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches that you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker. Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so with a great humor. Great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing Vice Chair of Supervision Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Thank you for allowing me to use this.
Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on monetary policy in the state of our economy. And I don't expect Chair Powell to weigh in on the mini debate we just had, but I think we all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. My colleagues and I are acutely aware that high inflation is causing significant hardship,
Acutely.
and we're strongly committed to returning inflation to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago. Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous FOMC meeting. From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer-run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said,
That's insane.
There's little sign of disinflation thus far in the category of core
Bruh, if they bring this whole shit back, this is fucked up.
half of core consumer expenditures.
All right, we getting into the money zone, guys. Let's see if this 5-minute money zone knocks or pops.
And there will very likely be some softening in the labor market conditions.
Ooh.
Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and current trends in productivity. Strong wage growth is good for workers, but only if it's not eroded by inflation. Turning to growth, the U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investments.
It's a big dog.
Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969. Job gains remained very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight, the FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
Stay the course.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you, Mr. Chair. There are 23 of us on this committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine won't get better because of interest rate increases. Every indication is that this pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war, which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect, but there is a job here for us to do in better aligning demand with supply.
Okay, understanding you have limited tools to address inflation, in our conversations in the past show my concern about continued rate increases that may not actually address the root cause of inflation. They hurt workers, and many of us contend we can't follow the same old playbook. Next question. Last year, 3 banking regulators issued proposed updates on the Community Reinvestment Act to account for changes in our banking system. My question is, does the Fed remain committed to work with FDIC and OCC to finalize a CRA rule, and when will that rule likely be finalized?
Yes, we do remain committed, and I believe we are in broad agreement with the other 2 agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give you an exact date, but
As quickly as possible.
Yes, but it will be some months.
Thank you. Banks weathered the shock of the COVID-19 shutdowns mostly because of the fiscal response provided by Congress. We now see a spike in loan delinquencies, an increase in overall risk. Banks are again plowing billions, as many other corporate leaders, always defended by people on that side of the aisle, into stock buybacks, which makes me concerned that if there's a downturn in the economy, banks could end up with too little capital. That's why I'm worried about any potential rollbacks of safeguards or regulations. Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part that we'll keep capital requirements strong.
I didn't expect you to comment on give me an opinion about you're looking more forward than companies that look at the short-term benefits of stock buybacks. Mr. Chair, when you last testified, I asked you about the risk posed by crypto assets, stablecoin, the Fed, and other regulated possibilities. How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud. We see a lack of transparency. We see run risk, lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate.
Yo, they saying the volume right now on most brokers is breaking the platform, bro. You can't even get into Tradeovate.
No way, really?
Dead ass, bro. I just logged off of my Combine account to get funded. I already made my limit for today. So I'm like, all right, let me go and log into my account, and I can't get in this bitch, bro.
What the fuck?
Word. Yeah, bro, the whole script is like fucked up. You're seeing HTML language. Gee, weedleakers. This dude he's like, yo, I'm in a fucking position and I can't get out. I can't even get in to like close my shit. You better get on the phone, bro.
Bro, you better hop on the phone like right now.
Oh, the phone is showing the same shit. Nah, they wildin'. These brokers be wildin'.
Good morning, Kiko.
Where's your baba? Where's your baba?
Yup, even on the fucking phone.
What's your baby? What's your baby? Get up.
Oh shit, and they printing right now.
Yeah, they going crazy right now. I just peeped that.
Oh boy, that's fucked up, y'all. Well, let me not shut down my TOS, cause y'all fuck me up. I'm gonna have to shoot somebody. Damn, bro, I took some fucking longs, maybe a little too early during the drag to the downside. I'm expecting these shits to pop though, if we can get above this level, probably. But until then.
Oh boy.
Oh, a channel cross on the 5, guys. Target is up here if we can make it. 15 minute got strong demand. Next 15 minute opens. This is like 30 fucking minutes. 10:45.
I'll be right back, brother. I'm gonna take Kiko out for
10
like a
minutes.
little bathroom break.
Do your
I'm
thing,
gonna leave my
dogs.
phone there. I'll be right back. Bam. Just
So we are watching right now to see if this bullish momentum can continue. We bounced off of a demand at 400 spot 74. Looks like they established. Trying to flip the 5 minute trend here.
oh, I got touted last night.
We
I
must
tell you.
promote and further the growth.
Yeah, I think you told me not last night, but you already got tatted.
Yeah, no, yeah, I got another one last night.
Got you.
Yeah.
So,
I finished up my arm with these SPX games.
oh
Alright,
man, this shit, damn.
Let me take this mask aside. That was crazy, bro.
They moving
Oh, that's still.
from standard deviation 5. Let's see what this next 5 minute
Bro,
candle
that's so-
does.
Bro, they really did fucking 500%. Like, right when the 7 o'clock candle opened, bro.
Have to flip this bitch. Break it. Oh, that's fucked up. You cannot get into Trader Day.
What? What? Let's go. Let's come back.
Insane. Come on, pop already. Ah, this contract is dead. Bastards. All right, so we got a white candle on the 5 minute right now for both ES and SPY with an oversold buy situation. That ended up paying pretty nicely on that pop. However, I guess it all depends on the contract you got. This one right here is dead, bro. Damn. Should've went with SPY, busy. They still got a lot of wood to chop. This is a big ass sell off on the ad. If we get back to 404, that was originally demand. They broke down that, so let's see if they could break back above. We'll put this fucking alert there instead of moving a new one. This white candle now is our new fucking demand that we don't want them to break this white candle. We don't want to go back down here. We want to make a full trip back up here. I still can't really make any call outs because this whole price distortion is just it's not a regular day. Yeah, I don't have to look at my shit. That shit is dead. Fucking A, bro. Let me see where these things came in from. $0.90 to $1.75 just now at the lows. Holy shit, dogs. Oh boy.
A record of $930.6 billion, an 18.5% spike from a year earlier, and an average credit card balance rose to $5,805. Over the past year, the Fed has acted aggressively to tame inflation, and yet we are still seeing price increases. As we've discussed this several times, but I recognize that it's been an ongoing discussion, but I believe that this further proves that we have long been feeling the effects of a policy-induced inflation resulting from decisions by the Biden administration, primarily cutting off the resources necessary to improve and increase domestic energy production. I continue to be concerned that if you attempt to use the tools that are available at this time for the Fed, then I believe that we're going to have a challenge of not being able to address specifically the challenges brought out when you have a policy is promoting higher prices with regard to energy, as opposed to what you're trying to do, which is to bring down the total overall cost. And I just wanted to ask, I guess, and you're going to think this is something that we've heard before, but do you believe that you currently have the monetary policy tools to actually reduce inflation? And I just put it in this perspective. In January of 2021, the CPI was 1.4% when the Biden administration began. In January of 2022, and this is before the Russian invasion of Ukraine, CPI was at 7.5%, 7.5%. Today, March of 2022, CPI is 8.5%. Wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
Senator, not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
In other words, you've got a limited number of tools available to you, and the limited number of tools that you have are designed to impact simply the reduction in prices and so forth. And yet, if there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy induced or whether it is a matter of a shortage in supplies from outside or whether it's war related.
That's right. Our tools essentially work on demand, moderating demand, and so that's what we can do.
So if there were policies in place that actually help to reduce inflation, in other words, and by that I'm just going to look at energy alone just as a good example. If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use
the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense, it is, but I would just say on energy,
I'm not trying to get you to a policy discussion with what the president's doing on his energy policy. I just want to make it clear that you have to respond to what's in front of you, and it doesn't matter where the inflation is coming from or what's driving it up. You're simply trying to bring it back down to that 2% number with the only tools that you've really got.
Yes, but I will say on energy, energy has tended over time to fluctuate up and down, and it's not mainly affected by our tools. So the things we look at are really things that are tightly linked to demand in the U.S. economy. Those we can affect.
And I think just the fact that you've been increasing interest rates, and yet inflation continues to ride up, would suggest, just as you've just indicated, that when you have high energy prices, it's tough to impact that part of it with the monetary policy that you've got available to you.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Thank you. One last question. Last June, Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the use of the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Okay, thank you. Thank you, Mr. Chairman.
Thanks, Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. Mr. Chairman, I want to take this moment to remind my colleagues that there are more than 62 million Latinos that call the United States home. We are the largest.
That pullback just took, that drop just took out the white candle. So we have to see if they defend this 400 level or if they create a higher low. This shit is going crazy.
109-year history of the Federal Reserve, there has never been a single member of the Board of Governors or regional bank president who has the lived experience of being Latino in the United States. And in practice, that means that the voices of nearly 1/5 of our country's people are repeatedly drowned out when the Fed is making critical decisions on economic policy. Decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. Right now, the Biden administration has a clear opportunity to make history with its next nomination to the Board of Governors. It has identified a number of highly qualified Latino candidates who have dedicated their careers to the fields of economics, who are committed to the Fed's dual mandate, who will preserve the independence of the central bank. The administration has rightly nominated and advocated for a number of diverse candidates with similar qualifications, both at the Fed and elsewhere. But despite having 5 opportunities over the past 2 years to nominate a qualified Latino economist to serve at the Federal Reserve, this administration has repeatedly chosen not to. Representation, or lack thereof, does not happen by accident. It is a choice, and I hope the administration makes the right choice with this nomination. Mr. Chairman, would you say that it is a truism that the United States dollar is the reserve of choice in the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Now, 12 years ago, a Republican House brought us to the brink of defaulting on the debt for the first time in history of this country, jeopardizing our credit and the world economy. I'm getting a sense of deja vu because, once again, Republicans are recklessly demanding draconian spending cuts to programs that hardworking U.S. families rely on in exchange for allowing the Treasury Department to pay for spending that Congress, including most of them, have already voted to authorize. You want to talk about spending cuts, it seems to me that the budget is the time to do that, but not to put the full faith and credit of the United States at risk. Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
So I guess I will start, if I can, by saying that these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due.
You always raise the debt ceiling. They never, every time they have this damn debate.
Ordinarily adverse, and could do longstanding harm.
Well, I think that's a mild statement of what would happen. I understand. I didn't ask you to engage in the congressional executive branch roles. I asked you about the abstract question of what happens if you have a debt default. Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
Of course.
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, seeing your testimony before the committee, is it fair to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have?
That's what we have. The balance sheet, the shrinkage of the balance sheet will continue too, but it's principally rate hike.
Yo, real quick, guys, before this 1 minute, we're getting into 50, right? So we have like a whole 10 minutes into this 15-minute candle. Look at this buying and selling pressure. It's going nuts. 11 million sellers to 6 million buyers. It was at one point at 9 versus 10. So this is crazy. I don't know. I guess I'm probably never clocked it during Powell's speak or whatever, but at this point, with that many sellers not breaking lows and that many buyers stepping in, it's anyone's guess, guys, but I really don't care about any of that. So far, shorting at the money zone paid a few times today. We do have a demand established at 400 spot 73. So let's see if they can hold this shit down, make some higher lows.
It would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates.
Mm-hmm.
You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay.
People are
So in
firing
effect,
more people.
I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not
the
wages.
you're trying to raise the unemployment rate.
There are a lot of
I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
All right,
Job
let
openings
me
could-
put it another way, okay?
Yo, let him answer, bro.
The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the
Okay.
Fed has tried to reduce inflation.
Now, right now, the current inflation rate's 6.4% and the current unemployment rate's 3.4%. Now, if history is right, I'm not asking you to again, blame anybody. But if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate's gonna have to rise to 7% based on history,
That's what the record would say.
okay? And to get inflation down to 2.2%, based on history, an immutable fact, unemployment would have to go to 10.6%,
Jesus.
would it not?
No, I wouldn't.
That's what the record shows, that's what the history shows.
Yeah, I don't think that kind of a number is at all in
I
play
mean,
here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight. But the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Sir?
It could work out that way.
Yes, sir. Thank you.
Thank you, Senator Kennedy. Senator Reed of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Thank you, Chairman Powell, for being here today. We saw in the wake of COVID the globalized supply chain disrupted significantly, and we're in the process, in some respects, of rebuilding a supply chain with an emphasis on sourcing in the United States. To what extent did that disruptive supply chain contribute to inflation, and to what extent will the new, if you envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak of inflation was all about spending on goods where people couldn't spend on services. So goods spending went way up, and the global supply chain, many goods are imported. The global supply chain just collapsed, and that was the source of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector that's everything else, which is financial services, medical services, travel and leisure, all of those things, that's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply chains. That's where the challenge is now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. You know, our monetary policy tools are famously powerful but blunt.
A different topic, and that is, as you're probably aware, the Fifth Circuit delivered a ruling in the Community Financial Services Association versus CFPB that the CFPB's funding mechanism is unconstitutional. Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and CFPB rely on the same source of funds and draw on those funds in virtually identical ways. If the Board of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary policy?
Well, it would be very significant, but I have to say we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
We've gone back and forth on the impact of rate hikes on workers, and you've indicated previously that wages have not been spiraling upwards necessarily, and that inflation expectations are currently stable. But the impact on increased interest rates are usually felt more by low to moderate income people. Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without softening in the labor market, without rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before, like the war in Ukraine, like the supply chains that you mentioned. So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
Thank you very much, Mr. Chairman. Thank you, Chairman.
Thanks, Senator Reed. Senator Brett, Alabama is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's great to have you here today. Over the past 2 years, we've seen the highest inflation of my lifetime, driving up costs for American families across the board. According to the U.S. Department of Labor, the annual inflation rate in 2021 was 7%, and in 2022, it was 6.5%. According to the U.S. Department of Agriculture, the cost of food went up 10% in 2022. And the real effects of that is moms and dads across this nation that are working to put food on the table for their kids, for their babies, had a harder time doing that. This has devastated hardworking Americans, causing a kitchen table crisis in every corner of our country, as the price of food, energy, and housing have all skyrocketed. In response, the Federal Reserve has raised the Federal Reserve Fund rate more than 4 percentage points. Being far from transient, inflation has remained persistent, high, and well above the Fed's long-run goal of remaining under 2%. In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
So I'd say a couple things to that. First, we're going to be looking at inflation in the 3 sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation. So we're watching carefully to see those effects come into play. So we're aware that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
So when you're looking at this, obviously not to get into a policy discussion, but if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by, really by demand, and our tools are really aimed at demand.
Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. So when you look at the unemployment rate, and we've heard my colleagues discuss people having to be displaced in order for us to maybe get to the inflation rate that we would like as a nation, I'd like to focus on the labor participation rate. So right now it's 62.4%. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
Hello?
Yeah.
I'm gonna hop off, bro.
All right, man. Have a good day.
I'm gonna get ready for the gym, but yeah, bro, good trades today, bro. If you wanna link up later, man, hit me up. If you want a game or whatever, bro, you know I'm here. Just hit me.
Enjoy your day, bro.
Alright, you as well, brother. Good shit today, bro.
Sure.
We're going, rinse and repeat tomorrow, bro. We got him speaking tomorrow as well.
All right, cool.
All right, brother. Later.
Hey guys, real quick check-in. Looks like the money zone is printing right now on the 5 minute. I doubt they fucking make it back up here. Well, who knows? I can't doubt it. 15 minute money zone is at 403. 5 minute money zone is at 401 now. 401.60s. So, and we do have demand established on the 5 minute at 40.70s. Looks like 15 is trying to establish some demand at 430s. We shall see what happens. You know where that shit just hit a little, right? You know where. I know where. Yeah, flatlined.
back to 2%, or pounding you on making sure that we don't push the economy into a recession and drive up unemployment. I got to tell you, and it's these are maybe not the cheap seats, but I actually think you've done a pretty good job in terms of both ratcheting up rates and then starting to tail off a little bit. I think we all were concerned by the January numbers where it popped up a little bit more. I wish, Mr. Chairman, we were actually having this hearing 2 weeks from now, because we're going to have a lot more data later in this week and next week. But I want to net. We've still got ways to go, and the January numbers were concerning. But I do think your tailored approach, we can all second guess, but I think it has been the right approach. I'm going to commend you on that. I want to get two questions in. One of the areas that I am very worried about is commercial debt. I mean, we've got a Bloomberg story here showing, we're going to hit a $6 trillion wall this year on refinancing. Where I'm particularly concerned is the issue around commercial real estate. As we recover from COVID, a lot of things are getting back to normal, but clearly the transformation of where people work is going through a fundamental transition, and I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side, and I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one seems to be more unique in nature, and how are you thinking about that issue?
So the first one on commercial debt, business debt generally, it's kind of been moving sideways as a percent of GDP, so you don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we were well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. As over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? It's not great for the largest institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small sized banks do. We carefully monitor it. We agree that that's an area that requires a lot of monitoring, and I'd say we're on the case. So,
well, that will morph me into my last question. Something we've talked about, and a lot of my colleagues have talked about with the large institutions. I mean, I do think even some of the biggest critics of Dodd-Frank, I think, would acknowledge our banking system is a heck of a lot stronger and was able to withstand COVID in a very healthy way. But what we've also seen evolve is a vast amount of financial institutions move beyond the regulatory perimeter. You know, the fact that we now have way over half of the mortgage origination coming from non-financing institutions, because a lot of the large entities, hedge funds, other funds that may be doing some of this commercial debt or some of the CRE debt. I'd like you to talk generally in the last 40 seconds or so of, you know, how you think about this regulatory perimeter. I'm a big believer, and I know some of my colleagues are, that, you know, that we ought to look less at charter and look at same risk, same regulation, maybe as a guiding principle. And you know, I know Senator Warren's been working on some work. I've been working on some work around crypto around that area. But there's a vast amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak up that happened in 2008 on the non-regulated side of the house?
I think you articulated the principle very well. It's same activity, same regulation. And that covers crypto and all kinds of other activities. People are going to assume when they deal with something that looks like a money market fund that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right, so much of intermediation has moved away from the regulated banks really for a long period of time. We got to keep an eye on that.
Thank you, Chair Powell.
We can keep looking at it.
Thank you, Senator Vance. I'm sorry, Senator Haggerty of Tennessee.
Thank you, Chairman Brown, and thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Bauer is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020. It was an acute, real-life stress test, if you will. And I think that our financial system navigated that admirably. In the past, Chair Powell, you told this committee that our financial system has proven resilient through 2020, and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. That's what the former one, Vice Chair Quarles did, and that's Dan Chiarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and this, to me, this just comes under that heading.
Well, as the review is underway, and I appreciate that context, one aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's General Counsel just yesterday alluded to undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized and made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring, and anything we do is going to reflect, tailoring of institutions according to their risk, and I mean that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So inflation's running core inflation's running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Mm-hmm. Indeed, it suggests that we still have work to do.
In that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.
Thank you.
Thank you.
Thank you, Mr. Chairman. So the Fed has raised interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but...
Oh shit, Ms. Warren speaking, boy. I love this lady. As much as she sounds hard on corporations, et cetera, I think for her age, her wisdom is just like incredible when it comes to like policies and just, holding people accountable. But if you just listen to how she structured her questions and her sentiment, it just makes a lot of sense to me.
Economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs. People who are working right now, making their mortgages. So, Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens if you do this. Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year. Exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very,
Just
very
looking at the
infrequent.
numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this, and
There have been 12 times that we've seen a 1-point increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that, but I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing that price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families. And if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Thank you, Mr. Chairman. Chairman Powell, thanks so much for being here. I have a question that's slightly far afield, but how often do you get to talk to the Federal Reserve Chairman, so I might as well ask it. So to give some context here, my family comes from Appalachia. Particularly my grandparents grew up in southeastern Kentucky, coal country, and then moved to southern Ohio, where I now have the honor of representing all of Ohio. And one of the things that you hear a lot when you study the regional history of Appalachia is it's often described as possessing a resource curse, right? So there's a lot of coal in central Appalachia that enables a certain amount of consumption. Obviously, consumption is good. People need food and medicine and other things. But there's also a pretty good argument that for a host of reasons, it causes malinvestment in the region. And
all right, so she just well, I think he did pretty well in trying to establish that the goal of their policy isn't to establish more unemployment, but he's under the impression that if they do nothing, then inflation will probably have a mass effect on probably raising that unemployment number faster, if not to some crazy number, because basically no one would be able to afford anything. Companies would not be able to basically continue to pay for people's salaries. I mean, like, we're talking about inflation having to wages having to go up because people are going to demand more in order to compete with the inflation of buying of cost of goods, right? Manufacturers are going to continue to have their goods go up because it costs more to ship it, et cetera, et cetera. Although we don't have like a shipping problem anymore, obviously there still is something that is like raising the inflation up. And I mean, I've already told you what I really believe is going on. The wealthy have bought up everything, and in terms of the stable stuff like the housing market, I mean, you know, these things cause the hands that own the majority of the wealth when it comes to the housing sectors are not the average man. It's not the average man. So they can sit on it while inflation continues to go up, but then another wealthy person comes and buy it, or an algorithm comes and buy it at above asking price, and it just continues to send inflation up. So like, they don't have to sell it for no low number. So of course the Feds are trying to do the best that they can by slowing the economy down, increasing the cost of goods to buy that, right? Like the interest rates. Your average man won't go and buy that because it's going to cost them too much, right? To kind of keep up with the maintenance of a mortgage rate. So they believe that that's the only thing they can do to slow down the purchasing that's happening at these high rates. But so far it's been 2 years of this monetary policy, and we haven't seen much of an effect. However, they do say that it takes a longer time, and I guess the other argument is, well, during that raising, you're going to cause more unemployment because employers can't necessarily compete with that rate hike, which I think is probably BS because, you know, employers make a lot of money but they do have big costs, right? Unemployment, benefits, all these things are some really, really big costs associated with being an employer. And then there's the manufacturing cost of goods stuff. So this is a big ass mess. Now, what I would say about this talk is they never really come to this with any kind of answers or solutions for the Fed or even ideas. It's just straight up, well, this is going to cost X, and the data and the study shows that you're going to cause more of a problem for families and stuff. And they're politicians. Their entire reason why they got voted for is because they had to pander to their constituents. So they're going to basically have this family approach, and you know, we're here for the people, and that's cool and it's good, but there's no solution here. What the fuck is he supposed to do? I mean, the Feds probably should have more tools in their arsenal other than just raising rates to cool down the economy. And maybe they need to explore that. Maybe they need to explore that with politicians. I think they have really good people understanding what the data does and what the effect has been historically, but we no longer ride horses. All right? The same thing that happened, or the same solutions you've had for the Great Depression or the mid-50s, it's just 1950s. It's not the same world today. It's just not the same world. So I do think they need to have more tools in their arsenal in order to get things working. But that's my
better than I do. Now, this has obviously been great for American purchasing power. We enjoy cheaper imports. Americans, when they travel abroad, benefit from lower costs. But it does come at a cost to American producers. I think in some ways you can argue that the reserve currency status is a massive subsidy to American consumers, but a massive tax on American producers. Now, I know the strong dollar is sort of a sacred cow of the Washington consensus, but when I survey the American economy and I see our mass consumption of mostly useless imports on the one hand and our hollowed out industrial base on the other hand, I wonder if the reserve currency status also has some downsides and not just some upsides as well. And let me just put a final point on this, and I'd love to get your thoughts on that, Chairman Powell. We're, of course, now the main supporter of a massive land war in Europe between the Russians and the Ukrainians. I read recently, and I'm not going to comment on how perfect or precise these estimates are, but I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2 minutes, Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used all over the world in transactions, and it's the place where people want to be in times of stress, is in dollar-denominated assets. Now, so of course we benefit by being able to pay for our goods all over the world, pay for everything anywhere in the world, mostly with dollars. That's an advantage. There's some economic theory around that it also has burdens of various kind, but I can't call it all back to mind. But the other thing is, it's a very stable equilibrium, but it's not a perfect one. It's not a permanent one, rather. So there isn't any obvious candidate to replace the United States right now, where you can have free flow of capital in and out of the country, where you can really trust the rule of law and democratic institutions, and keeping price stability, which you can here.
Do you think it gives us less control over our own currency, the fact that it's become the world's reserve currency?
Control over our currency. I'm not sure. So essentially, what we try to control is price stability, and no, it doesn't make it harder for us to keep inflation under control. The United States has a smaller external sector than most large economies, where it's only about 15%. So mainly what affects inflation in the United States is domestic supply and demand.
Do you think it makes it harder for us to to fight back against currency manipulation, to control the export and import flows in a way that stabilizes our own manufacturing sector?
Well, I mean, what's important there is really the level of the dollar, and when the dollar is stronger, obviously our wares are more expensive abroad and that kind of thing. But we don't have an opinion on. Matters of the level of the dollar really matters for the Treasury Department and the elected government, not for the Fed.
Thank you, Chairman Powell.
Thank you, Senator Vance. Senator Van Hollen of Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here and for your service. I know the Fed is experiencing lots of challenges these days. I've got a couple questions that are just, I think, basic yes or no's, and then some longer questions. Would you agree that changes in the size of corporate profits can be one of the factors that affects the inflation rate?
Yes.
Right. Now, recently we saw that the Employment Cost Index, which, as you know, measures the growth of wages and benefit costs, grew at roughly 4% on an annualized basis in the fourth quarter of 2022. Is that right?
That's my recollection, yes.
So if corporate profits were to decline from the extremely high levels that we saw recently, would it be possible to sustain the 4% growth rate in the Employment Cost Index for an extended period of time, even as we get inflation down to the target of 2%?
Depends on what you mean by extended period of time. So you would not, without a very, very large increase in productivity, which would be great, but that we don't expect, you wouldn't be able to sustain 4% wage inflation over the longer term. Over the shorter term, though, yes.
So over the shorter term, that would not be a justification in and of itself for raising rates. Is that right, in the short term?
Well, I think wages affect prices and prices affect wages. I think we do think that some softening in labor market conditions will happen as we try to get inflation under control, and will need to happen.
Right, but that's more a prediction about your efforts to fight inflation. Are you saying that simply looking at the current 4% growth rate in the short term is an excuse for jacking up interest rates?
I think what I would say is that the overall, all the data we look at in the labor market, including not just that measure of wages, but others, also unemployment, also participation, also job openings and quits and things like that. All of that, you put that into the picture, and I think you see a labor market that is extremely tight and is probably contributing to inflation. I've never said it was the main cause.
I think the larger point here, based on your response to that first question about growth in profits, is right, is corporations have a decision as to whether or not they're going to pocket more for profit, which they can, or provide higher wages to their employees. And if you actually lowered your profit margins, you could sustain a higher wage increase without violating the 2% inflation. Isn't that right?
Yes, I mean, when I hear profit margins, what we're seeing in the economy is pretty much about shortages and supply chain blockages. And when there's not enough of a product, what happens, and there's a lot of demand, what you see is prices going up. As the supply chains get fixed and shortages are alleviated, you will see inflation coming down. You'll see margins coming down, and that will certainly help with inflation.
Right, but profits are the margin, right? They're going up beyond what they were before. That means that even with the increase of costs because of supply chains, they're making more profits. Which again, that they can do that. But my point is that as a contributor to inflation, as you indicated in response to the first question, let me ask you about the tight labor market because one of the issues in a tight labor market is parents with kids, including a lot of moms who would like to go back into the market, but are not able to do so because of lack of affordable childcare. The other issue is immigration, and I know that you've gotten some recent data on how some immigration figures actually have softened a little bit the tightness in the labor market. Can you just talk broadly about those two factors, affordable childcare and immigration, more legal immigration, and how they could affect labor force participation and therefore also reduce inflation pressures?
So on the first, we don't make recommendations or evaluate fiscal policy, but I will say there's research that shows that it helps keep women in the workforce when there's childcare available, which is, I think, kind of self-evident. The second was
impact of immigration.
Immigration, yeah. So what I talked about with you is actually as part of the January Bureau of Labor Statistics report, which comes the employment report for January, which comes out in early February. There is a section in there about more people. The Census Department has increased its estimate of the workforce by something like 870,000, and a significant part of that has been immigration. And that has moved up participation by a little bit, but it may be part of why we're hearing. It may be part of why we're hearing from in the labor market that the really intense labor shortage pressures that we were hearing about in 2020 they're looking for. They want to know how we're thinking about this, but we will try really hard not to get on a slippery slope and find ourselves becoming climate policymakers. It's just not appropriate for an independent agency.
Okay, and I completely agree, and I hope you stick to that. And I think you ought to, ask the banks to consider what the overreaction might, what kind of vulnerabilities that might expose. With that, with regard to what Senator Warren was saying on her monologue, one thing about ideologues, they have the luxury of binary choices. You have a really big job, and you have a single, in my mind, one and a half, maybe two missions. I think the first one handles the second one okay, but it's got to be tough when the White House is working against you and you don't have to comment. Thank you. Thank you, Mr. Chairman.
Senator Tester of Montana is recognized.
Chair Powell, thank you for being here today, and thank you for serving in this critical role at this critical time. I have talked many times in this committee, and I, especially right now, cannot overstate the importance of the Fed's independence. I said it in the previous administration, I say it now, we cannot be playing politics with our economy, and that is a fact. From a climate standpoint, I would just tell you it's entirely artificial right now anyway, because if you look at the hundreds of billions of dollars this country puts out every year in disasters due to climate instability, we ought to be asking our question, is that sustainable? Because quite frankly, it has to be done, and I don't think it's sustainable. So we've got to start looking for some solutions on the climate side sooner rather than later. The Reserve has a tough job, and I really appreciate how you've done it. Reasonable, working together, making hard decisions for the good of the economy. We have to get this right. So the question is, how much has inflation decreased since its peak?
It depends on the measure, but it's meaningfully, at least a couple percentage points.
Okay, and has unemployment gone down as inflation has gone down?
Unemployment has gone down. Yes, it has, to now a 54-year low.
Yes. So the question becomes, and I always think back to in 1998, I bought some property, and the interest on that property was 10% in 1998, and I thought I got a hell of a deal. I thought it was just great. But the truth is interest rates have been artificially low for the last, 20 years, probably? And the question becomes, as you look at the economy and as you try to make the determination whether the inflation is caused by demand or supply, where does all that fall in to you, your decision-making moving forward?
Oh, you mean the level of interest rates? So in theory, there's this thing called the neutral level of interest, and we know it only by its works. And neutral is the level that neither pushes the economy up nor pulls it down. And it changes over time. This is the thing about these important variables in economics. So what's happened until now was that the neutral level of interest went down and down and down to the point where, many countries had zero interest rates and very low inflation. Now we have this series of shocks associated with the pandemic, and we have rates at 4.5%, our policy rate, and we have the labor market very strong and inflation reacting somewhat, and it does raise the question of where's the neutral rate. Honestly, we don't know. I think we look at the current situation and we see that there's not a lot of evidence hard to make a case that we've over-tightened. It means we need to continue to tighten. I think we're very mindful of the lags with which our policy works. We don't think we need a significant increase in unemployment, and we're certainly not aiming for one. But we do think there'll be some softening in labor market conditions to get to 2% inflation.
When you're looking at interest rates, I know we talk about energy prices here and the price of gasoline, and then if you go over and Europe is much, much higher. Are we comparable? I'm just curious. Are we comparable with our interest rates here as with, say, Europe?
We're very close to where Canada is. We're a little bit higher than where Europe is. Europe's traditionally had much lower inflation. They now have very high inflation, and they're still increasing rates, but they're a bit lower in terms of rates.
So if we do not get the inflation under control, and like I said, I think the steps you've taken have been reasonable and measured. If we don't get it under control, what are the impacts of that?
Well, the social costs of failure is one way to think about it, are very, very high. So if inflation were to continue, at some point that will become the psychology. People will come and businesses will come to expect high inflation, and that will make it more self-perpetuating. That will mean an up and down economy. It'll mean it'll mean something that looks more like what we've seen in periods of high inflation. Capital allocation is difficult in a world like that. It's not a good time for the economy. What we want to do is restore price stability firmly back at 2% so that we can have the kind of strong labor market for a sustained period that we had before.
Once again, thank you for your work. Thank you for your independence. Senator Daines.
Thank you.
Thank you, Senator Tester. I'll be handing off to Senator Cortez Masto when I'm finished up as well. So, Mr. Chairman, good to have you here today. When I am back in Montana, the number one issue I hear certainly across the state is the high cost of gas, the high cost of groceries, and overall how their paychecks are shrinking because of inflation. It's a crushing blow. It has real life impacts. It's a top of mind issue for Montanans. It's also important to note the devastating impact it's going to have on our nation's economic future. In fact, in October of last year, I sent a letter to Congressional Budget Office Director Swagel regarding the impact that high inflation and the elevated interest rates would have on the cost of servicing the federal debt. His response painted a less than rosy picture, but then we got the CBO's updated 10-year baseline forecast in February, and it confirmed the truly dire situation that we find ourselves in. Driven by interest payments on the debt, the CBO now projects the cumulative deficits, your window, and I recognize.
This looks like it's getting ready to go, guys. Looks like we keep rejecting the money zone, as you can see, but it's getting really, really tight. We got a few money zone rejections along this entire band here on a pullback. Another one just now, another one just now. And contracts, you can see, they bottomed out at 190, shot up to 240. This 15-minute is not it has not established a divergence line here yet, but you do have buyers trying to buy this zone. So yeah, I guess we're still kind of waiting on the next move here. And calls are just dragging down, like just dragging down on this move. Sick. That move got you to 30 something. Yeah. Calls just shaking and rejecting their money zone. And longs are basically bouncing at their money zone. I mean, sorry, shorts are bouncing at their money zone and longs are rejecting their money zone. So anyways, we'll see if they break through this bottom. 6 million sellers in this 15-minute candle. It ends in 2 minutes. And then we'll have our final, our final 11 o'clock candle come out. This is an hour. Oh, I'm like, what the fuck? I'm like, why is that hour so long? What? 15 minutes for three candles? What? No wonder why I was like, we're never gonna hit that fucking 1 hour 50 money zone. Could be this move though. What up, Dot? Oh, that might have been the last stop on those. Who knows? But this was a nice 15-minute money zone rejection from the fall. Oh man, Jesus, it's just a bloody day.
We're going to be bearing the challenges with higher debt service over the course of the next several years, where we're going to see debt service exceeding defense spending, which is we see the threats of China, threats around the world.
Really quick, guys. This is a new accumulation candle down at demand. 15-minute actually has an established zone down here. We have a reversal play in effect for the upside. How do you play that? You wait for a friggin' pullback as far as you can into that demand zone so you can easily stop out. I would go with a YOLO, and see if we can kind of get out of this bearish trend. However, right now we're contesting the, I don't know if it was that one. Yeah, it was this one. We're contesting the 5-minute money zone to the downside. The target on that would be somewhere around 402.30s. The top of the Bollinger Band on the 5 minutes. I need another contract here. This one's just dead. The ad added a little bit. So that's the reversal play. The short-term plays, you still have them, one at this money zone, which they're contesting, the 5 minute, and then the other one around 40160s, which is close to VWAP. And your stop would be the 50 HMA there at 402, on top of the Bollinger Band, which may be where the rejection happens. So that's kind of a tough play. But anyways, it doesn't matter because they could reject that money zone on this reversal play. So we're just trying to see if it fails. But we do have demand at 400 spot 70s on the 5 minute, 400 flat on the 15. I'll be right back, guys. Reversal play looks like it could go, but we have some haters coming in right here on the 5 minute. DB probably tank after this candle, but DBD. Ah. All right. Check. So this would be the type of pullback, guys, I was telling you about on a reversal play. We have a 15-minute established demand, 5-minute demand up there, but I wouldn't take it up there because this whole dollar pullback into demand on the 15 minutes. So you kind of want whatever you want to draw a line, whatever. Just a pullback is what you kind of want before you enter these longs. Because if you would have entered up there, this pullback would have eaten you alive, right? That would have been a 145 fill. You made it to 160, and now you're down to 120. So you lost 20 cents. You get in here, if they bounce off of anything, so this is 114 entry now. If they break lows, you're gone. Yeah, sellers are not fucking around, bro. Oh, they just broke lows. Oh, they're close enough. So now this is a $1 fill if you take this pullback. This is something I've been trying to test too. Like, forget trying to like catch the. Look, I guess you can't really say that. Still lower than where you would have gotten it though. Oof, man, those pullbacks are sick. Like they aren't fucking around, bro. I'm clapping. Breaking. Fucking A. So, right, we don't enter until we see some sort of controlled support there, I guess, but until then, damn, these friggin' puts are just friggin' shooting from the right zones. All right, let's see if this happens, if they get a rejection here, or if they break out. Yeah, that's the plan. Oh, they clapping shit. 4K, they're saying bulls have the bid stacked at 4K. So they're talking about, yes. this shit like it's gonna make another run. Look, white candle sends the puts to the upside type shit on the trend. Yeah, guys, fucking nothing crazy. It's not like crazy volume that brought the market back down, other than that previous, or I don't know, the beginning of this candle. Oh, it's 2 more minutes. In this 15-minute candle before 12 o'clock, and this thing has selling pressure at 98%, 100% here.
I certainly think that particularly our natural gas assets have helped Europe make the transition.
Any sense of how much worse the global energy picture would be if you would imagine a world where we're not producing and shipping energy to other countries?
It'd be hard to estimate.
Probably worse.
Yeah, I mean, I think it's been clearly Europe has managed better than expected, and a part of that story is just U.S. energy experts. Also, the winter wasn't as bad, and the Germans made some good decisions.
Yeah, we made some prayers that says we need to pray for a warm winter for Europe, and I think they got one, which was something's been helpful. I'm out of time here. I'm going to send this back over to Senator Cortez Masto.
Thank you. Chairman Powell, it's great to see you. Thank you so much. I know it's been a long morning. Always appreciate you coming to talk with us here on the committee. I want to first align myself with the remarks from Chairman Menendez supporting a Latino nominee to the open seat on the Federal Reserve. It's been more than 100 years, and a Latino has never served on the Federal Reserve Board. And I know there are many strong Latino economists and economic experts who would capably serve. So I want to put that out there. Chairman Powell, I also sit on Senate Finance. Right across the way, we are talking about affordable housing. I think for purposes of so many of us across the country, including in Nevada, when we talk about affordable housing, it's also about workforce housing. It's about making sure families that are working so hard have an opportunity to keep a roof over their head. Right now in Nevada, if you're making minimum wage, you have to work 75 hours a week just to be able to afford housing. And so I want to talk to you about this. I was distressed to see in the report that that activity in the housing sector has contracted as a result of the elevated mortgage rate, and you've been talking about that. I often hear from Nevadans who say, I don't know if I'm ever going to own a home, and many feel resigned being stuck in a cycle of renting. So, Chairman, how do the Federal Reserve economists and leaders think about the balance between keeping interest rates low to spur that affordable home building and home buying while addressing inflation?
We have a dual mandate from Congress, as you well know, which is maximum employment and price stability, and that's really what we take into account. We don't, and of course, interest-sensitive spending is the thing that gets the most support when we cut rates, and the thing that is most affected when we raise rates, and that means housing to a significant extent. That's not a choice that we make. That's just the way it works. And we only have really one tool, which is monetary policy. So, you know, we don't really try to use our tools to affect broader housing policy, but really just to achieve our statutory goals.
It happens to just unfortunately be in effect as you try to achieve your statutory goal. Is that?
Yes.
Yeah. And so I want to have you have the opportunity to address Senator Warren's conversation with you earlier about the tools that you have and the impact that it has on causing potentially more people to be unemployed, and this obviously has an impact on their ability to afford homes as well. Can you address that?
I'd be glad to. I want to be clear that we do not seek, and we don't believe we need to have a very significant downturn in the labor market. And it's not just hope. I think if you look at the situation in the labor market, you've got all these job openings, and in principle, you could reduce the job openings without seeing a really significant increase in unemployment. Also, you're starting from such a strong labor market. It seems as though you're a long way away from anything that looks like a recession, just looking at the labor market by itself. So honestly, we don't know that we need that there will need to be a really significant downturn. Other business cycles had quite different backstories than this one, and we're going to have to find out whether that matters or not. But I do think that I've said all along, and my colleagues and I have too, that we believe that there's a path to restoring 2% inflation with less significant effects on the labor market than have typically been seen in downturns.
And for purposes of the general public, people, Nevadans that I know that are struggling, we have one of the highest, we've talked about this, and thank you for always being willing to talk with me. We have one of the highest unemployment rates in the country. Our service sector was hit so hard. We're still at over 5% just in Southern Nevada. We have high gas prices. We have grocery prices. We have housing prices that are high. So one of the things that you have commented on, and you just did again, but I know it was in your opening remarks, that, and it's quoted right here, and let me just say, our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. For the general public, for those working families and people, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another. How
does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not, it's not obvious how that is, but 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because the evidence is and the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. If everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So having a 2% inflation goal, which we had for many years, de facto we had it, then we formally adopted it in 2012. But for years before that, we were effectively targeting 2% inflation. And what that meant was that inflation, it's one of the reasons why inflation was low and predictable, is having a real target and sticking to it, not changing it, at convenient moments. So we think it's really important that we do stick to a 2% inflation target and not consider changing it. We're not going to do that. It just is, people will be better off if the whole question of high inflation is just not part of their lives. That's kind of the definition of price stability. It's if people live their lives without having to think about inflation all the time.
Thank you. I notice my time is up. Thank you so much, Senator Lummis.
Thank you very much, Madam Chairman, and welcome, Chairman Powell. When you're setting these rates and making these decisions and seeking that 2% magic number, are you considering the cost of borrowing for the United States, knowing that Congress has over borrowed and that we have overspent and that the national debt is at now at least 97% of GDP, and that we're going to face challenges of our own making. This is not about what the Fed has done. This is.
So guys, it looks like it's still a tough battle here at the 400 level. I just kind of keep looking at, I guess, volume, seeing if anyone's stepping in here to kind of support this idea that we could bounce at this level, or you can just wait for the bounce to occur and probably get in on a pullback. But as I said, definitely don't take it from the first evidence. Wait for that pullback, as we did yesterday, to the downside for this same exact move, and then we could potentially enter this to the upside. But you want to get in as close to this demand line as possible once that snap happens, because you want to be able to stop out in the event that they don't hold this level that we believe someone's buying from. All right. And I mean, you can look at the contracts, just saving yourself all that headache by, holding out. And now we're basing off here. Had a nice little wick to 90s. So I don't know, maybe another one, and then probably have to be a go. But so far, we're just sitting on our hands waiting for this thing to kind of come in for us. In the meantime, puts are still just kind of printing. It's like a printing press, straight up at the money zones. The force is coming in, sending the contracts right back up, giving you a good opportunity to get out on at least SPY. SPX must be going crazy right now, but we shall see what happens if they break. Oh, baby. In the meantime, I am going to go and DJ, but let me see if I can put this play up. All right, so what we got here? We have the whole day kind of happened. For me to throw a plays up there, it kind of sucks ass, but we'll see.
With safe and sound banking practices. I'm going to say that again. Even after a bank's capital, BSA, AML, and risk management, a bank issuing a stablecoin on an open, public, or decentralized network is highly likely to be inconsistent with safe and sound banking practices. So I'm a little confused about where we're heading on stablecoins. Does the January 3rd statement mean that the Fed has decided that stablecoins on a permissionless distributed ledger have no place in banks?
So I think that there are real concerns about permissionless public blockchains, and the reason is that they've been so susceptible to fraud, to money laundering, and all of those things. So I think what you heard from the federal banking agencies in one of their reports was that they would tend to look at those as not consistent with safety and soundness.
And what about properly regulated stablecoins? Do you think they could have a place in our banking system?
I certainly think that in a world of appropriate regulation, where the same activity, where stablecoin activity gets the same regulation as comparable products in different places, then there certainly could be a place for stablecoins in our financial services sector.
Thank you. The European Union, UK, Australia, Switzerland, Singapore, and others have all moved over the last few years to create a legislative framework for digital assets. The European Union in particular is attempting to be a standard setter again, like it was with its data protection rule. Is the United States in danger of being a rule taker, not a rule maker, when it comes to digital assets?
I do think it would be important for us to have a workable legal framework around digital activities. I think that is important, and something Congress, in principle, needs to do, because we can't really do that.
Yeah, thank you. Senator Gillibrand and I agree with you. One area we've already seen is in the Basel Committee on Bank Supervision. they propose prudential treatment for crypto assets framework, setting forth banks' capital standards for digital assets. The Basel Committee's framework does not impose a capital charge for digital asset custody, whereas the SEC's Staff Accounting Bulletin 121 imposes a prohibitive capital charge through the back door and places consumers at risk in bankruptcy. Similarly, the Basel Committee framework allows banks to issue or hold digital assets on their balance sheet if the requisite capital is set aside. So back to January 3rd, 23, the Fed and other bank regulators have said that it is forbidden for a U.S. bank to conduct these activities no matter the capital. So my question is, what does the rest of the world know about digital asset regulation that we do not, that the Fed does not?
So as we discussed, this is an SEC staff accounting bulletin, and it's not something that the Fed issued, and I'd be loath to comment directly on it.
The issue is, and what concerns me, is that the Fed and other federal banking agencies are not following international norms on digital asset regulation. That's just my comment. Thank you, Chairman Powell, for being here. I now recognize Senator Smith.
Well, thank you. And Chair Powell, it looks as if Senator Britt and I are the last people standing at this committee hearing. Thank you for passing on the gavel to Senator Lummis. And I want to thank you for your service and for our recent conversation. And before I get into my questions, I would just like to note there's been a good back and forth amongst our committee around some of the big economic challenges and opportunities that we face in this country. And I would just like to note that the programs and the spending that the ranking member and some of our colleagues have blamed for inflation provided critical relief that kept working families and small businesses afloat during a global pandemic. And in fact, many of these policies were passed on a bipartisan basis and signed into law by both Republican and Democratic presidents. And I also just want to add that the laws that the Democrats passed to lower prescription drug costs and healthcare costs and to lower energy costs for Americans are helping to lower basic costs for families, all of which, by the way, was fully paid for. So I return, Mr. Chair, to what you have said to me privately and to all of us publicly, which is what we ought to be looking for is striving for bipartisan solutions to find a path forward. And in fact, Senator Lummis and I were just talking about this yesterday when it came to housing policy. So just want to put that out there. When you and I spoke yesterday briefly, we talked about the Community Reinvestment Act, and I know that I appreciated the chair raising this point earlier in the hearing. But I want to just return to that briefly. I am very glad to see it's been about a year since the Fed and the OCC and the FDIC issued the proposed rule to modernize implementation of the Community Reinvestment Act. I don't think that the proposal was perfect by any means, but it does make really important improvements to how, through the CRA, financial services organizations can serve and meet the needs of communities that are full of assets, but lack the resources to make it happen like wealthy communities can. So I think, Chair Powell, you indicated that you expect this new CRA rule to be finalized in the coming months. Is that what you indicated?
Yes, that's right.
And can you just tell us, with the departure of Dr. Brainerd, who will be spearheading the CRA efforts?
So I've asked Vice Chair Barr to be responsible for moving the project forward. Of course, it has to go to the whole board,
right?
And everyone gets a vote on that. But he'll be pushing it forward.
That's great. Thank you. I was glad to see that disaster preparedness and climate resiliency were added to the definition of community development activities that would be eligible for the CRA credit. And this is important, of course, because low and moderate income folks and the communities that they live in often face some of the worst impacts of climate change and extreme weather events. This isn't social engineering. This is dealing with the actual costs and challenges that people experience because of climate change. So, Chair Powell, can you talk to us a little bit about how you see that change and how it fits with the CRA's overarching objectives?
So I think it fits for the reasons that you said. Honestly, I'm a week or so away from getting a briefing on where the proposal lies, so I'm reluctant to touch on. I mean, again, I'd rather wait till after I'm fully briefed on where that agreement came out, after the FOMC meeting. So,
Thank you. That's fine. I'll look forward to continuing this conversation with
As will
you and with Mr. Barr, and just appreciate this. I think, my view of this is that climate change and the economy are inextricably linked, and the reality is that climate-related action or inaction has a direct financial impact on people and our economy. I was wondering if you would just be willing to update us briefly on some of the next steps that the Fed is going to be looking at as you evaluate the resilience of financial institutions to with respect to climate risk. There's this pilot project that just was started in January, I think it was, of this year, and I'm curious to know how you see next steps there.
so we're doing really two things. One is we are doing a climate stress scenario, which the banks are already doing, the large banks, the 6 that we're working with, and that's really just to begin the process of understanding the risks that are associated with this over the longer term. They're already doing it, and it's something that there's a lot of learning going on around the world, actually. The other thing we're doing is providing guidance. The banks want clear guidance. They actually want one set of rules globally. The big banks that do business around the world, they're hoping that they aren't in a world where there's just different regulatory regimes everywhere they go. So we're kind of working on that as well.
Great. Thank you very much, Mr. Chair.
Thank you.
Thank you, Senator Smith. Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being here. In your opening statement, I was here for that. I think you touched on some of the interest rate sensitive components of GDP and non-interest rate sensitive components of GDP. I think you said that we do have a concern in the latter group: inflation expectations, labor market tightening, et cetera.
1 second, bro.
Can you tell me a little bit about how you're looking at the interest rate sensitive and non-interest rate sensitive readings, and whether the Fed, what sort of Fed actions can take place to avoid a zero landing?
Sure. So on, the housing sector, of course, is intersensitive spending is the thing that they're very directly affected by our policies almost right away. And the poster child for that is housing. And so you've seen mortgage rates now go back up over 6%. You've seen housing starts come down. Activity in housing has declined as people are reluctant to get out of their the low rate mortgages they had before. So housing activity is.
Guys, you seeing that shit? Nice little bounce off of that reversal play we spoke about, waiting for that pullback into a zone that we like. And this market just fucking exploded. White candle told us we could get a green. We got that. Prices now moved from 399 to 401. They have to hold this. Wow. 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 Anyways, all right. So that's that. That play actually hit target already. Top of the Bollinger Band. So if you want to get out of there, you can. If you want to hold that for the 15-minute bullish flip, you can. Good luck. Cons, man. Cons just went from like $1 to friggin', let's see, we get out of this. Holy shit, $1 to friggin' 220, 100% in fucking 10 minutes. I'm coming right now, bro. Guys, don't forget you still gotta beat this downtrend. So just giving you a heads up. Don't know if this full reversal is gonna send us back to the north side, but we had enough. We had enough to understand that could have happened. We hit target on a 5 minute for that channel cross, that reversal play actually. Looks like they're getting some smoke up there on this bearish trend. Let's see if they stay there. Like that. Q. That was sick. Come on, you bastards, go out there. Oh, I just missed it, Jesus. Give me some, give me some, give me some. What was that? Away before I go. Can you again? Good night. Cancel that, sorry, my bad. Oh, bro, that was a big ass. What you call it? Let me see that. Before I let go. Dum, 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 dum. Dum, 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 dum. I wanna know, I wanna know. Before I let go. Dum, 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 I can't let you go. Oh, oh, oh.
Order filled.
Let's see if we could take some, take these things back down into 15-minute demand with a tight stop though, right? Cheers, sir. Look, this shit ain't even moving right. The bid ass is somewhere back there. Somebody hit a 50. This shit still ain't moving. Is that some shit? Ah, missed that bitch.
Order filled.
I think it was right there. That would have been a little more. See if it gets through this 40-70 demand. Oh shit. Yeah, I think I'm done for the day. Fuck it. Let's just cancel the trade. Let's lick our wounds and call it a day. That was a pretty dope play. 15-minute demand gave us 1, 2, 3 candles. We knew not to take this spike to the upside. Well, we didn't know. We could have kept running up, but we didn't take that spike to the upside. And same exact play we did yesterday, waited for the pullback into demand again, and a break of that was a go time. Contract shot up from 98 cents to 230. Five-minute guy, green candle pullbacks with demand, supply right at 401.33. Let's see how much they bring that back. Guess the bulls want to hold this level now, 70s. Uh-oh, here it goes. Snap-a-tootie. Oh my God. ES is still going. For this reversal to still be in effect, they have to hold the middle, I believe, of the Bollinger Band. So, I mean, I don't ever turn that on, but it would be this activated BB band, mid BB band on, mid BB band. They could hold the middle of the Bollinger Band. You might see the bounce to the upside to start the trend, but again, like I said, this 15-minute money zone to the downside is another play in effect. So basically, they have to hold that line there. It's the middle of the Bollinger Band line. Which is looks like half of the play too. It's fire. Ooh, buddy. All right, I gotta get out of here.
Less interest sensitive than that, and that's restaurants, it's travel services, travel and leisure, it's healthcare, it's financial services, healthcare services, all those services, and that's a big part of our economy. This sector is 54%, I guess, 56% of consumer spending on non-energy and food. So it's very important, and it's about having a little bit softer demand and about having some softening in labor market conditions. We think our tools will work on that, but we do expect that will take time.
Thank you. I know the chairman, in his opening comments, mentioned, I believe, I don't want to misquote him, but I believe that we have too little capital in the banking sector. May be true of a couple of banking institutions, but how do you feel about the current capital that our broader banking sector, irrespective of where they are in size? What concerns, if any, do you have about the capital that we see out there already?
So I supported all of the capital raising that we did. I joined the Fed in 2012, and we were in the middle of implementing all those Dodd-Frank increases, and I supported all of them. After careful thought and discussion with my colleagues, I think the new vice chair is doing what new vice chairs do, which is to take a fresh look and ask the question, even though I think...
Just wanted to point something out really quickly, guys. So you see these little wedges right here, this like V-shaped wedge? That's a pullback zone for entries on the upside swing. Since we're above the 50 HMA here, they started showing you a possible good entry for that reversal play. So, even down there, if they would have failed, it's always about, capital preservation and stopping out if that move fails on this reversal play. So that was kind of like a really good zone to get in on. Right here is telling you again when they pull back, and we don't have that 200 moving average activated on the charts, and the reason is because I want to keep the charts with less clutter. Too many lines will make you pretty much handicapped, but basically that would have been your next entry there on this money zone pullback to the upside, but you're going against this cloud here, so you could really have a 15-minute big boy come and slam you back down into demand. So, it's all risk, it's all probability. I don't know where you would stop out if you got in on this one. Going all the way back down to 399 is quite the blow. That would be like the equivalent of getting in right here and going back down there. And then if they break, you're done. So, I don't know. I don't know where I would put my stop there on that play. Yeah, that's a hard one. That's a hard one. Let's see if we can get another. So into cyan, dark greens is a nice pullback. Into cyan, I want to kind of like see another white snap this up to the upside, white candle. But I don't know, maybe, yeah, I guess you gotta use this. Yeah, all right. I keep saying I'm leaving.
For supervision, we don't have any proposals yet, but at some point we will.
Yeah, I'm going to be meeting with the vice chair, and we'll drill down on that topic. But I do know, I was over in Finance Committee, so I wasn't here, but I do know that several members, well, first off, we know that Vice Chair Barr is looking at a holistic review of capital requirements. I think that that's a good idea. But I have to ask a question. Do you think, does the Fed consider the bipartisan passed Senate Bill 2155, which is currently the law of the land, superior to any of the Basel requirements or any holistic review process? In other words, it is the law of the land. How does that weigh into how these reviews go?
So 2155 was, I think you're talking about tailoring. So Dodd-Frank actually called for tailoring, and what 2155 did is it said change may tailor to shall tailor, and it also changed the thresholds.
Yeah.
But tailoring is an absolutely bedrock aspect of our bank regulatory system, and anything that we do is going to reflect what we think is appropriate tailoring between the different sizes and risks of the financial institutions that we supervise and regulate.
What we were trying to accomplish as a part of that, I don't expect you to respond, I know that we're coming to the end of the hearing, is that a holistic review of a financial services institution is going to reveal the fact that many of these financial institutions are very different based on the activities that they're most involved in. And those sort of holistic reviews may actually result in increasing capital requirements for two banks that look like peers, but not for another because of the inherent risk associated with their business focus. Does that make sense?
To your earlier point, though, the law, the Dodd-Frank language, and as amended, actually requires that we take those things into consideration. So
And I hope
we
that we
certainly
will.
will. We will.
Thank you.
Thanks, Senator. Senator Warnock is recognized from Georgia.
Thank you so very much, Mr. Chairman. Before I begin my questions, I know that this committee will soon consider a new nominee to serve on the Federal Reserve Board of Governors. And while it has not historically been the case, it seems to me that the board should reflect the diversity of our nation, that those things are connected. Policy and representation are connected. And I hope that we will see sitting before this committee a nominee that pushes us closer towards our ideals of e pluribus unum, out of many. One, and I support Senator Menendez and others who have called for a diverse nominee, specifically the fact that we've never had a Latino person serve on the Federal Reserve Board. I think it's a huge oversight, and I hope we can move quickly in that direction. That said, my state of Georgia is in a housing crisis. Like much of the country, the Federal Reserve Bank of Atlanta has designated owning a home in Atlanta as unaffordable to the average home buyer. But this is not just a city problem. Harris County, Georgia, with a population of less than 35,000 sitting on the border of Alabama, is also rated as unaffordable. In the midst of this housing crisis, the Federal Reserve continues to raise interest rates. This makes mortgages a lot more expensive for families, especially young families looking to buy a house. According to the National Association of Realtors, the share of first-time home buyers is at an all-time low, while the average age of a purchaser is at an all-time high. Chair Powell, you have said that there has been, quote, an imbalance in the housing market. But if you're a Georgia family, parents in the mid-30s, young children, and all you want is to be able to afford your first home and place and build equity to one day pass that equity on to your kids, how are the Fed's actions helping that family afford a home?
Our mandate is to provide maximum employment, use our tools to foster maximum employment and price stability. And we're using those tools really now to restore price stability at a time of the highest inflation in 40 years. I think that the same people who are having high mortgage costs, if they have a floating rate mortgage, are also experiencing high costs for all the basic necessities of life. And one of our most fundamental roles at the central bank is to keep price stability. So we have to prioritize that in what we do.
Yeah, I understand the tools and the mandate, but my concern is that we could have a cure that's worse than the disease. It doesn't do families any good if we stabilize housing prices while mortgage rates continue to skyrocket. It doesn't matter to me why a house is unaffordable. Maybe the house is unaffordable. Maybe the mortgage is unaffordable. Unaffordable is unaffordable. How does the Federal Reserve consider the total price of home ownership, including costs of mortgages, in executing that mandate to keep prices stable?
Housing inflation is a very important component of various inflation indexes, and the way that's calculated is the economists look at rents, and then for people who own a home, they impute a rent depending on the value of the home. So it actually does factor in, and I would say measures of new leases that are being signed and new housing prices show significant declines in inflation, not in price, but in inflation. And that will play through so that overall inflation over the course of the next 6 months or a year will decline.
If we're seeing mortgage rates go up, yes or no, does this discourage folks who may have a low interest mortgage rate from putting their home on the market and then possibly paying double the cost on a mortgage for their new house?
It certainly could. People who are in a low mortgage, a fixed rate, low rate mortgage, I would assume many of them are not moving.
Does raising the federal interest rate change the cost of borrowing for a company hoping to develop new housing?
Yes.
Does it make it more expensive for suppliers to finance expanding production to meet supply needs?
It does.
Does it give businesses less wiggle room to offer higher wages and attract qualified workers?
Indeed.
So all of these actions have to be taken into account. Federal Reserve does not control housing supply, but its actions do have a massive effect on housing supply. And some of these supply effects, it seems to me, will be felt for many years, well beyond when interest rate hikes have slowed or rates have even gone down. And I know you've got a difficult job and a tough situation, but I just hope that the Fed will think more about its actions and how they affect housing supply, even as it attempts to control housing demand. Thank you.
Thanks, Senator Warnock. The last question, I believe, questioner is Senator Sinema is remote from Arizona.
Thank you, Mr. Chairman. And Chairman Powell, thank you for being here today. In raising interest rates last month by 25 basis points, the FOMC cited Russia's war against Ukraine as a key contributor to elevated global uncertainty. The war has serious implications for global energy and agricultural markets. And as you know, energy inflation in particular can appear in the form of higher prices of other goods and services. This feels like a substantial driver of inflation overall, and in my mind, you can't understand the global economy fully without assessing the range of possible outcomes in Ukraine. As we've also seen, the war created new supply chain problems overnight and has caused abrupt price swings in select committees. How is the FOMC assessing the economic impact of the war and the range of potential outcomes in order to inform how it sets monetary policy?
So the principal, I guess there are two things to say. One is that the principal way that the war has affected our economy is really through commodity prices, grain and particularly energy prices. That's the main thing. I think really, and those have both flattened out. Energy prices globally have settled down and they're at a higher level, and food prices as well to some extent. So the second thing I would say is that it represents a significant risk. So the war in Ukraine, the outcome is uncertain, developments there are uncertain, and you have to think of it as a source of potential risk to the global economy and to our economy. We don't, and we look at alternative scenarios and things like that. We don't really do it from a geopolitical standpoint, but we do, of course, model scenarios where commodity prices are higher and things that would look like what could happen from Ukraine.
Thank you. At home, Arizona families are struggling to navigate this economy. Higher prices are making it more difficult to afford groceries, gas, rent, and airfare. But on the other hand, rising interest rates are crowding out investment and making it more difficult for first-time homebuyers to buy a home. Inflation has also slowed housing development to a halt in Arizona. And as you know, Chairman, housing is a major economic contributor in my state. It's also clear that more spending comes with trade-offs. And it's why tackling inflation has historically been so difficult. And yet it's more important than ever that we get it under control. There's been much debate about a soft landing, where we get inflation under control without triggering recession, versus a hard landing, where inflation comes down but triggers a painful recession. Some economists are currently saying they see no landing right now, that growth is actually accelerating, and that more aggressive actions will be needed to get inflation under control. If true, that would be problematic. What do you think about that assessment?
Well, as I mentioned earlier, I think if you look at the data that's been coming in since earlier this year, you have seen stronger labor market conditions, higher inflation, stronger consumer spending, and also we saw some of the low inflation readings from the fourth quarter of last year revised away. If you take all of those, they may be to some extent related to things like seasonal adjustments or a warm January, but nonetheless, they all point in the same direction. And they do suggest that the possibility that that ultimately would need to raise rates higher than had been expected. Of course, we have 2 or 3 more very important data releases to analyze before the time of the FOMC meeting. Those are going to be very important in the assessment we have of this relatively recent data. We'll be looking carefully at that, and all of that will go into making the decision, which we have not made, but making the decision that we'll make about what to do at the March meeting.
Thank you. On February 23rd, the Fed, the FDIC, and the OCC released another joint statement on crypto assets and liquidity risks posed to banking organizations. It's clear that regulators see undue risks for banks in the current environment and are taking a more conservative approach. Do you believe these risks are inherent to crypto assets and how they behave, or is some of the risks a product of the current regulatory and policy landscape for crypto assets in the U.S.?
So we're seeing, really, in the last close to a year now, we've seen just a remarkable set of events in the crypto space. Lots of companies collapsing. We've seen massive fraud. We've seen all kinds of things. I think, we have to be open to the idea that somewhere in there is technology that can be featured in productive innovation that makes people's lives better. However, in the near term, we see in crypto activity lots of things that suggest that regulated financial institutions should be quite cautious, and that's in doing things in the crypto space. And that's what we've issued 3 or 4 releases to the banks, along with the OCC and the FDIC. The Fed has, and they essentially say you really need to be careful here. You need to be careful. It's early days with crypto. There isn't the appropriate regulation. We're learning lots about the risks, and they are many of the same risks that run in other parts of the financial system, but without appropriate regulation.
Thank you, Senator Powell.
Thank you.
Thank you, Senator Sinema. We conclude the hearing. The Fed must make sure that workers and families are at the center of every decision it makes to strengthen our economy. We've heard a lot today about the role that Wall Street plays in our economy too. As you've said, Mr. Chair, we know that higher capital requirements make banks safer and stronger. It allows them to make investments in their workers and their communities and our economy. That's what they should be doing instead of spending billions on buybacks. I look forward, Chair Powell, to working with you to strengthen our economy. For senators who wish to submit questions for the hearing record, these questions are due 1 week from today, Tuesday, March 14th. To Chair Powell, please submit your responses to questions for the record 45 days from the day you receive them. I thank my colleagues for the very, very good attendance today. Only one member on each side was not here, one for health reasons, the other just because he's doing 12 different things.
Alrighty, guys, that is a wrap. It's a long talk since 10 o'clock to 1. I'm sure those guys are excited about lunch right now. As you can see, we tapped into the target zone here at the top of the Bollinger Band, and price literally came back down. Doesn't mean we can't bounce again. I don't know if that's what's going to happen, but generally you want to catch that move there to get all this IV back on the contracts. I was trying to get this contract at like maybe 80 cents, 90 cents. Definitely sub 100 as opposed to kind of getting it way up here. But, I guess 130 is 130, 137, whatever. 140 wouldn't have been a bad fill given this price action back to $2. This contract has been oscillating between this range of the standard the divergence line for some time now. As you can see, this was the first pop to the downside. Went from about 80, 70 cents all the way up here to, $2.55 on the drop. Then with that bounce, it went right back to 80 cents, took its time to kind of climb back up to the $2.40 range. Dropped just now on that pop that we caught, which was the reversal play, and then just now took its time to go back up there to break above the 50 HMA, pull back entry, boom, bomb. That's what I was trying to catch, but I really needed it lower than that to really kind of capture this move. But nice move nonetheless, nice ideas to short the 15-minute money zone after the pop into our target. Going for the continuation is definitely possible. I can show you yesterday we actually did that. But it was after a pullback too, so this might be a double bottom. So we caught this move to the downside, which was this exact same play, but just the opposite of it, right? So this is a short 15-minute consolidation, 5-minute double top. On this pullback, we caught that break. All right, we wait for that pullback. And you kind of try to get into double top levels. This break got us back into the bottom of the Bollinger Band. Nice little play there for I think 150%. If you got out of there, you didn't have to suffer that. And then this was another, I guess, break there of that zone. But basically supply held it down, and that's what made those two plays work. So if you have that same reversal play idea, you're expecting this was your first break, here goes your second break. Here goes your second down move. And that shit looks like it's going to crack. But the other one looked like it was going to pop, so, whatever. This bitch is gone, dog. Boy, that bitch look gone. Boy, that bitch look gone. Yeah, those blue candles, I don't know, I don't want that. But I definitely saw this. Ooh, Charlie, she is a goner. Oh boy. Damn, this shit did not let it go back up. God damn.
Order filled.
What? For what?
Order filled.
Try to get me on some longs. I gotta remember to start taking some of these things out of them, like make sure I cut everything. Golly, bro, that right there. It worked. There's no pull back into this line. It worked. There's no pull back into that line. I'll be back, guys. Happy trading. This shit is dead, bro. That looks strong. Let's go check out some stocks with some unusual volume. AMD longs. Wow. Wow. I'm supposed to be watching this damn thing to see when the call outs come in on this. When the call outs actually come in on this chart. Let me just add something now on customize. TT. So AMD firing north. This Activision long didn't kind of work out. Yeah, I gotta figure out when they come in here, cause oh, it was a put. Okay, so that worked out. These are some DKNG calls. Oh, let's get back to spot. My bad, y'all. Trying to do something over here. This shit is over, boy. What you call it? Let's go. Long ideas, nothing. Joe's penny option volume. Volume spikes. Accelerating 14. SE went up $14 today. Is this Dix? Money's on pullback, money's on pullback, money's on pullbacks. It's a nice trend here, yo. Whoa, what a day. Might have to start looking at other fucking stocks. This thing went up 10, $14. this one? Dick's Sporting Good, another one went crazy. You know what I'm gonna do? I'm gonna detach this here and keep this active on another screen. So that way I could at least watch them and say, all right, Dick's just came in on that scanner. It was up 60 cents, that's nothing. $3 on Cara. So the reason why something like this would come up on this scanner, right? It's a volume spike. The average 30 days on this has 949,000 in buying, in just, let's just say, transaction and volume. Today it did 6.1 million, and that's what it's up to. But I'm assuming that during this volume spike is where you had the most volume on this contract. Equities volume, Twigo, yeah. The rest of this is just, you know, whatever, but that's where you had most of your volume. That was pretty nice. Whoa, baby. Earnings. Huh. SE, did it have earnings? Earnings. Okay, and last but not least, Cara. To the downside. Man, it's nothing crazy. What was the one that was like $5? Oh, that wasn't it. This is $3, right? Yeah, but that was from yesterday. It went from 10 down to like 7. All right, cool. Let's go and look at some other ones. This is option volume. Spike number 3. NVIDIA calls. Straight out the gate, 235 to 238. Move down to 234, 240. It's a nice move today.
person is in custody in regards to this kidnapping that happened on Friday in Matamoros, which is a small Mexican community across the border from Brownsville, Texas. We continue to follow major breaking news at this hour. The Associated Press and Reuters are reporting 2 of the 4 Americans who were kidnapped in
No, just put them in the garbage.
Okay, now what? What's the next step?
We're gonna add scoop of sugar. What in the caucastic collard greens? All that sugar, all my stomach bubbling.
And what's the vinegar for?
We're trying to cut the bitterness. Wait, so she's trying to kill bitterness with vinegar? Of course.
Yeah.
Smell that? It smells good. There you go.
Oh,
Ain't no way that smell good cooking in that sugar and bacteria broth.
are you gonna drain it?
Right. You gotta be able to get the sugar and the vinegar flavor out of it. Yeah, but you forgot about the ground flavor over that root sour. And she really about to eat it like that. Watch this, watch this, watch this, watch this, watch this, watch this. I ain't never seen nobody eat collard greens with a steak knife. I woke up one day and stopped. I pulled one of these right here. Boy.
Hey guys, yeah.
I got my own dick over here, and it's bigger than my son dick. Okay? So we gonna get that all cleared up. Huge news. Hong Kong is giving away 500,000 plane tickets to increase this huge.
Buy a house in 2023. Instead of buying a house, you should actually rent a house and make money with Airbnb. How do I do that? Number one is you go on Mashvisor and look at the performance of similar properties in the area.
I personally don't believe anybody could stop me. I really, that's just how I believe. I personally don't believe anybody could stop me.
These are my top 3 reasons you need to.
13,000. Tough time never lasts. Only tough people last. Wow.
हमारा कौवा कौवे बुलाएंगे देख लो अभी आसमान खाली हैगा कहीं भी एक भी नहीं है नजर नहीं आ रहा देख लो आप ये देखो देखो ये आना चालू हो गए ये आ रहे देख लो देखो देखो ये आना चालू हो गए
Did you know the largest resort in the Northeast is only a 2-hour drive away from New York City?
Do you think gay men suck dick better than women?
This is why I quit HelloFresh. I have some home chef all over the place.
All right. Bears have it today, bruh. They got it today. This shit gone. Okay, I think a new one just came out. It's 330. This is crazy. They broke through this 400, now we're at 398. Those things made it to 348. Wow, bro. Son of a bitch. This shit is not stopping. It ain't over. One, two, three, four, five, six. Shit, real quick. It's 147. You should have went for a different contract, bro, because the ones you were looking at, at this point, you can go for this one. Come on back today. Oh, come on back just a little bit, you son of a bitch. It's a whole fucking 500. fucking, what you call it, the 180 of bastards. Damn, these shit's flying, guys. They're not even giving you a chance to touch this shit. Like, this bitch is selling off. That's what I'm looking at, some 396s, but them shits are gone, dog. They ain't giving me a fucking chance. Definitely don't want these. Do it, do it. Yeah, it's not giving up nothing. Oh my God. No way, ain't no way you touching that. I'll just be FOMOing if I tried to get on this wave, man. I would have gotten on there right here for this break. During this blue candle, when we pulled back a little bit on that red, but I missed that opportunity. I was your closest into the money zone on the 5 minute that could have gotten you that move. But if you FOMO into this now, you'll be taking a flush play. You could keep going, but contracts gotta come back, dogs. This shit is hot. Too hot. Look at that, you would have taken that chop. They hit me at 125 on that bitch. Alright, probably could come back some more too. I don't want that much. I just want to go in for the trend. See if we can get it. See what happens. Might be a micro pause. Let's just close that out. See what we get. It's gonna be hard. She ain't no 155. Ah, you suck ass. Yeah, whatever. I feel like I got in there kind of late though, so. I'm gonna take these yellow candles and then get a mean wick. I could have gotten a cheaper price. 150 something got hit. Watch that shit dump. Yeah, what the fuck? I swear to God, I don't understand how y'all be doing me dirty like this. What was my exit?
I said, I'm not even heard Kevin Samuels say stuff like color purple. Like that was.
I did a 150. Okay. As opposed to 138. Yeah, fuck that. Like I wanted a cheaper fucking price there, bro. But you gotta wait for that shit to come back to the money. That'll bring the contracts real nice. Probably 60 cents. Then the up move will probably get you back to 140, 150. Hopefully breaking highs. Selling pressure is at 55% on this 15-minute candle. It is over in about 2 minutes. That shit was white, by the way. Alright, let's go read what the hell this thing means. So, red, B1, fire, 2. I don't know what the fuck those are. Some lessons to your trade. Let's go to. I'll be right back to this, guys. So AI has a 6. Squeeze custom edit formula for 5 minutes. Yeah, let's apply. Just had a daily squeeze. another squeeze, forward squeeze to the top side. I don't get this. Dark red market compression is currently in this time period. The number reveals the amount of dots on the TTM squeeze indicator. Okay, gotcha. So if it's in dark green, market compression is currently in this time period. Alright, that makes sense. And red, bright red, the stock is in a buy zone. I don't know about that, Playboy. On a 5 minute. Green. Yeah, that's trash. Activision is in green. Dark red, market compression is currently in this period. Alright, got you. Okay. Let's look for bright red, buy zone, arc. I could see that. Yeah, I could see that. Nice pullback. Alright, I don't like this scan. I mean this column. Let's get back to SPY. Whew. What a fucking bleed off today, man. Literally hit the 550 on that. We spoke about this thing here being a good bounce zone for today. It ended up being the rejection zone. We talked about what that possibility could be. A massive fall off, because that was a major level on every time frame. They caved through that shit. Let's get back to it. Man, what a fucking exit on that candle. Alright, they're back to the money zone. This is the kind of bounce you want on SPY before you really fucking enter. Cons are literally at 72 cents. Put up that risk, don't give a shit. See your cons back at 174 in no time if they break lows and continue with some violent speed as opposed to like stalling in this range. If they go up to the 15-minute money zone, that's a kill. That's a murder, death, kill. Nice. Fucking nice. That shit about to shoot. It went up to 1 already. They crushing this shit. Crushing, absolutely crushing this shit. Which one did you want? I wanted that one, right? Yeah, that's the one that came back for you. Yep. That's the one that came back for you to, oh my God, 60-something cents. Guys, I would just say, be careful. You know what to look for. You know what to look at. And I'm out of here.